Sky-high mortgage rates appear to be at an end. With the Federal Reserve's latest action on interest rates and signals to the market, the U.S. housing market could see some increased activity on both the supply and demand sides of the market. In today's video, we're going to cover the latest developments affecting mortgage rates, where they could be headed in 2024, and what that means for home prices moving forward. Let's get into it. At the end of the Federal Reserve's two-day meeting this week, we got some great news. They decided to maintain their pause on raising the Fed funds rate, which was widely expected. But what was more noteworthy was the projections for the Fed funds rate in 2024, which indicate that cuts are on the way. The median projection came in at 4.6% for where the Fed funds rate would end the year, down notably from the 5.1% in their last projection released in September. What this means is that it would take 3/4 point rate cuts to get to 4.6% from the current Fed funds range of 5.25% to 5.5%. In response, the bond market rallied, and this week the 10-year Treasury dipped below 4%, continuing a downtrend from back in October when the yield was around 5%. The bond market is pricing in these future anticipated rate cuts into bond yields, and as long as there are no surprises such as an unexpected increase in inflation, that 5% high back in October was likely the peak Treasury rate for this business cycle. Now, what does this all mean for mortgage rates? For home buyers and sellers, it's great news. As of December 14th, the average 30-year fixed-rate mortgage was 6.95%, the first time it has dropped below 7% since August 10th of this year. It has been on the steady decline since the end of October, which was a response to the 10-year Treasury yield peaking and heading lower. Given what we're seeing in the bond market now, I fully expect the 30-year mortgage rate to head lower as well. The next question is, how low could it go in 2024, and what will that mean for home prices? Let's deal with the first half of that question first. The best way to gauge where the 30-year mortgage rate is going is to consider where the 10-year Treasury yield is headed. As of the recording of this video, the 10-year Treasury was at 3.9%. If the Fed follows through on its rate cuts next year, we could easily see the 10-year Treasury move closer to 3% by the end of next year. Let's take a look at where the 30-year mortgage rate might end up if we had a 3% 10-year Treasury yield. As I've mentioned in previous videos, the 30-year mortgage rate closely tracks the yield on the 10-year Treasury, which you can see in the graph here. Looking back over the last 20 years, I find that the average spread between the two has been 1.8 percentage points. Given that historical difference with a 3% 10-year Treasury yield, we could see the 30-year mortgage rate hit 4.8% next year. This would have a huge impact on housing affordability. As of October, the average housing payment as a share of median household income in the U.S. was at around 45%, the highest in recent history. This is based on a mortgage rate of 7.6%, which was the average in October. If everything else stayed the same and I just switched the mortgage rate from 7.6% to 4.8%, I calculate the average housing payment share of income would fall to 34%, which is much more in line with the historical average and puts the average home back into an affordable range for the average buyer. A mortgage rate below 5% would be a huge boost for housing demand, and as long as supply remains tight, it would be big upward pressure on home prices. But we might see an uptick in supply as well. Remember that a lot of sellers have been on the sidelines, not wanting to sell their home that was financed by a 3% mortgage rate just to buy another one with a 7% mortgage rate. This is seen most clearly in home sales over the last year. A lot of transactions that ordinarily would have happened just didn't take place because of these high mortgage rates. So there is a lot of pent-up supply that could come online and would be a counterweight to the increased demand. Overall, I think we're going to see the median home price head higher in 2024 as mortgage rates come down. But because we're also likely to see supply increase, the price increase shouldn't be too great. I don't think we're going to see another housing boom like we did during the pandemic years, where the median home price shot up more than 20%. Somewhere in the 5 to 10% range would be more likely. But this assumes everything plays out as expected in terms of the Fed cutting rates and the 10-year Treasury yield falling to around 3%. The big wild card here is the U.S. economy and whether we enter an economic recession next year, as several analysts think we will. In my last video covering the latest economic data, there were some signs of weakness emerging for U.S. consumers, but more recent data is showing it's too soon to count out the U.S. consumer. November job growth and retail sales both headed higher, pointing towards another quarter of positive growth for the U.S. economy. I'll be covering the latest economic data in an upcoming video and assessing the risk to the housing market, so make sure you're subscribed and hit that notification bell down below so you don't miss when that video comes out. And if you like this video, don't forget to hit that like button to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.